Good morning and welcome to our 10 minutes at 10 today. So, we've been talking a lot about cash this week in the Facebook group. If you're not in there already, do pop in. Look for us at Bloody Brilliant Business Club on Facebook. So, today we're going to talk about cash flow KPIs and what are the six most important cash KPIs, the numbers that you should really be knowing in your business.
So the first one is how much is physically in the bank account, plus of course any overdrafts you have available, plus of course prepaid cards such as Revolut, Pleo, anything like that where you actually have cash which you can spend.
Yeah.
Key to know exactly what is available in each of those scenarios.
And it's so important to know what's available. If you're looking in your business accounts, you'll often see a different number as your bank account balance versus what the actual cash balance is in your bank. And the differences there are often down to unposted transactions. Perhaps it's cash in or cash out that's been received into the bank but hasn't yet been accounted for in your business. So when you're looking at your most important cash KPIs, it's really good to make sure that your accounts are up to date so that you don't have the difference in this number. So your business accounts will take into account things that you've paid yet but haven't cleared your bank. So that's important to know when you're doing your cash KPIs and your cash flow forecasting.
Yeah, want to plan for the timing discrepancies.
Yeah, absolutely. And you need to understand those. So the further the further out that your accounts are, and the less up to date they are, the more difficult it is for you to do this. But if we want to get control of our cash, because cash is the lifeblood of our business, cash is massively important to manage, to understand, and to control. We need to know what those cash numbers are. So number 2 in your business is how much you are owed. So how much do people owe you?
And not only that, as well as how much you are physically owed, it's important to know what the payment patterns are of your customers.
Yeah,
Because if you've got one of your customers set to, say, 30 days end of month, if you're chasing them after day 7, it's going to be pointless because they're just simply not going to pay until later on. So it's important to know the payment patterns of your customers. And if you are using a system such as Xero, make sure that your due dates actually reflect that, or at least use an expected date to reflect that if they always pay, say, slightly after the actual due date. And then that way you can actually forecast and see what's going on.
Yeah, I think one of the challenges that we often see in business is if we're dealing with some of the bigger customers and some are a national or a corporate company, blue chip companies, even though your payment terms may be 7 days, 14 days, or 30 days after the invoice is raised, quite often with the bigger companies, you are reliant on their payment terms and you have to fit into their payment cycle. So sometimes it doesn't make any difference if they've signed your contract and your terms and conditions. If they only run a month-end payment run, then they only run a month-end payment run. So you have to make sure that you're in that payment run for that month-end.
Yeah, irrespective of how much you chase, you're going to get paid at the end of the month. That's the way it works.
Yeah,
so
what
you've got to make sure is that you are there. You've given them the details they need. You've given them everything they need, so purchase orders, everything, to make sure that you are included on that month-end payment run. Do not miss that bandwagon, because if you do, it's not like they can push it through the next week. You'll probably be waiting another 30 days.
Yeah. Now, and the other thing to consider is what happens if you're dealing with overseas suppliers. Your payment date might be due on the 30th of the month. Now, that might be when the cash leaves their bank account if they're paying you on time, but it might not get to you for another 3 to 5 working days if you've got international payment clearance terms to go through. So once you know how much is in the bank and how much you are owed, you have an idea of your cash availability. So if you're doing a weekly cash flow forecast, or you're trying just to get to grips of what you need to have in the bank now to pay your liabilities, then this gives you your cash availability. So the sum of how much is in the bank and how much you are owed is your cash availability if that cash comes in when it's supposed to.
So the third step is to know how much you owe. Sounds like a bit of a no-brainer, but actually that's one that often causes headaches for people, because you might get a late invoice, or your due dates in your system might not reflect the actual due dates of the invoice, and there might be things missing, things coming late, etc. So there's actually quite a lot that could go wrong with this element, but it's important to know exactly what you physically owe to your various suppliers.
Then we want to know what our weekly business run rates are. So if you have an understanding of how much needs to go out of your business this week, then you have a better chance of being able to accurately forecast your expenses and to be able to look at your cash flow. So make sure you know what your weekly run rates are. Now, not all weeks are going to be the same. You might have, for example, a week where a loan repayment or a mortgage repayment goes out, and that week has a higher cash draw than the other 3 weeks of the month. So make sure you understand what your weekly run rates are in that month and which week you're in when you're doing your cash flow forecasting.
Yeah, really important. They do vary a lot. And then extending from that, we also want to know our weekly or our monthly personal run rates. So the timing of your personal big bills, such as your mortgage payments, such as any other agreements you have in place. If you've got a credit card repayment, you want to know the timings of those, because that helps. Cash is so much more than just planning for the business, because if you're
Yeah,
drawing
very
cash
much
out
so.
of the business, you also need to know how much you need, and you need to know when you need it. So it's really important to understand the two side by side to give you a full understanding of your cash.
And that's the same again. If you've got, say, a big mortgage payment and it goes out in week 3 or week 4, you might need to put more cash away as it comes in weeks 1 and 2 to make sure that you've got enough cash in your business to pay yourself in week 3 or 4. Now, if you've been off and paid suppliers or HMRC, or you've made other payments out of the business, perhaps you've bought things that maybe you don't really need to, then that cash that might have been earmarked for you is now suddenly not available. So super important to understand how much you need to be taking out of the business each week. So our 6th cash KPI is going to be your tax liabilities. So we want to prioritize our tax liabilities. And if we know that we've got a corporation tax bill that's due in September, we want to be saving for that from January and make sure we've got enough cash put away in our business to be able to pay our corporation tax. Don't let it hit you in the bum and take you as a surprise at year end. So you should know how much your tax liabilities are, how much you need to put away each week to make them so that you don't have to pay late and you don't have to ask for arrangements to pay and you don't have to worry about not having enough cash for your tax liabilities, and then waterfall that cash into a different bank account. So if you've done all of this and you've got your key cash KPIs, each week, say on Monday when you do your cash flow forecasting, you should know how much is in your bank, how much you are owed by your customers, how much you owe your suppliers, how much you need to put aside to cover your day-to-day overheads for your business, how much you need to put into your waterfall account so that you've got enough to cover your own personal expenses, and then how much to put aside for tax. If you do that and you understand those cash KPIs, then you shouldn't run into trouble.
Mm. But as an extension of this, it's not actually a point in the actual process. But if any of your clients are experiencing cash flow issues,
I think you need to
make
know.
sure that you know, because if they have any difficulty paying, then you might actually want to set up a payment plan. And then all of a sudden, if they did have difficulties and you didn't know and you'd forecast for cash in and it didn't come in, all of a sudden you've got a bit of a cash flow knock-on effect. So you need to know if they're experiencing issues as well and have those conversations with them if they are, so that you can formalise an actual repayment plan.
And then that helps you do your cash flow forecasting as well, because you'll have regular little sums coming in rather than waiting for one big sum that never arrives. The other thing that we think is quite important, we deliberately didn't measure or didn't include credit card debt in how much is in our bank and our cash availability. Now, a lot of businesses do have credit cards, and credit cards are fine if they're used for monthly spends and then you pay all of those spends off the following month. So they're good to be used for working capital. They are not great to be used for creating debt. They're really, really expensive. We all know that. So that's the last thing we want to do. However, actually, and the other thing with credit card debts is the credit cards are often in the person's name rather than the business name. So it's your liability if something goes wrong with the business rather than the business's liability.
And the way that credit cards work, it kind of actively encourages bad spending habits,
Yeah.
because the money's so easy to access, but you don't have to pay anything until later on. So it doesn't really, I don't know why, it just doesn't really fit into people's, oh, I need to pay that back kind of persona and spending habits. It's
Yeah,
just spend the money, it's there.
it
So
encourages us all to want everything now, doesn't it?
yeah,
And
rather
and
than
that's one of the
waiting.
biggest challenges that I have. I think credit cards are too readily available to people. We've always, we probably get one a month that drops through the door here. We've been pre-approved for a credit rating of, blah blah blah, and you think, oh great, but I put those in the bin. Not everybody can do that. So if you're in a position where you're struggling with debt, that's very, very tempting to start putting things on credit card. And then you create this spiral where you get the cash in, you've got expensive debt, you might have used it to buy stock or pay bills, and then the interest charges become quite crippling and outweigh any advantage that you've gained by actually buying the stock to be able to sell it.
Yeah,
So credit card debt is so horribly expensive.
it's just too easy to spend.
Before, yeah, too easy. And it's too easy because you want this, you want that, you want the other, you want to catch up with everybody else. Bob down the road's been on this training course, so you want it as well. And it's so easy to go out and spend things unnecessarily and make poor business decisions by using a credit card. And you quite often hear, which quite perversely, coaches and business advisors saying, I was broke, I had nothing left, I put this, £20,000 training course on a credit card and it changed my life. And it does, perhaps for the minority, but it doesn't for the majority. What it does is just increases your debt. You might argue that actually doing something like that makes it more compelling for you to get off your bum and make it work and pay it off. But
It's
I'm
more
an
high
accountant.
risk.
Yeah, as an accountant, I'm
Yeah,
risk adverse, so
yeah,
I would rather work the other way. If you are in a position where you are thinking of using credit card debt, if you've got your cash KPIs, you know what you owe, you know what you are owed, and that's still not enough to balance your figures, my first thoughts would be, what can I do now to generate instant cash? I would rather work harder for a few evenings or a few weekends, put a special offer out to customers, create a new product, go through my expenses and cut out all the rubbish that I don't really need, anything to avoid credit card debt. So, what can you do first? Go for instant cash. Try and have a number of strategies up your sleeve, things that you can do when you're really stuck, when the poop has hit the fan and you really can't do anything else. What can you do with a little bit of effort to generate instant cash now rather than go onto credit card debt?
And the thing with cash flow is it's one of those things that shouldn't be a gamble. It should be, in fact, actually, there's many ways to improve cash flow just by being efficient with how you manage it and understanding it. And that's why this week we are doing a webinar live tomorrow, and it's going to be based on getting in control of your cash. So basically, this week we've covered understanding what's going on with your cash, why this thing might be happening, why that thing might be happening, getting a hold of our KPIs and understanding what we're actually measuring. And then we're going to look at getting in control, getting those fixes in place, and future proofing it to prevent it from happening again. So it's all one of these things where it can be readily controlled just as long as we take the measures that we need to.
So that's it from us today. Your six key cash KPIs. Understand how much cash you have available, what's in the bank, how much you owed, how much you owe, what your weekly business run rates are, what your personal business run rates are, and what your tax liabilities are. If you understand that, you should be able to generate a half decent cash flow forecast and get more in control of your cash flow finances. That's all from us today, and we'll see you again soon. Thanks for watching. Bye.
Bye.